Let's talk about another weak job market that will likely solidify a Fed rate cut. August non-farm payrolls increased by just 22,000, which was well below the estimate of 75,000. That's about a third. It's a very bad report. This weak report also comes with another month of negative revisions, as employment in June and July combined is 21,000 lower than previously reported. They keep revising down on these numbers.
Yeah, and I'm just going to say, if you take 22,000 minus 21,000, I mean, really today there was like 1,000 jobs created because you had the two negative revisions. I mean, not very good. And then, I mean, you look at the top performers with healthcare and social assistance, they continue to lift the headline number as those sectors added 31,000 and 16,000 jobs respectively. I'm going to do some quick math here. That's about 47,000. So if you didn't have that, you'd be looking about negative 25,000 in terms of the payrolls. I mean, that's a problem. And many other areas in the report actually saw declines, with payrolls in construction falling 7,000, manufacturing declining 12,000, and then professional and business services dropping 17,000.
The personal and business services dropping, that one surprised me. Now, it could be mortgages, people aren't selling mortgages, but I'm kind of surprised. That's a big
But I'd push back on that, because if you look at mortgage demand, year over year, mortgage demand is actually up pretty substantially. There's more refinances. They have the weekly mortgage report. There is more production of mortgages now. So, I don't think it's the same way that mortgages got hit, a couple of years ago when rates really shot up and now nobody was refinancing. Refinances year over year, last I saw in the weekly report, are actually up.
I guess the refinancings, which is surprising to me, because who's refinancing out these rates? Because when it got to 3-4%.
People that bought at 8, 7. So, I mean, there is a pool of people that can refi.
I guess I'm thinking about the real estate people that are really having a hard time right now. So,
I guess they're having a hard time compared to 2021, 2022, but I mean, things have gotten maybe relatively better.
Yeah, maybe it's normal now that it feels bad.
I'll leave it there.
Let's talk about the government, because they also saw a decline of 16,000 jobs, and I worry this is a ticking time bomb, since employees on paid leave or receiving that ongoing severance pay are counted as employed in the establishment survey, and those that opted to take the government's offer at the beginning of the year, well, they'll start coming off severance pay as a deal lasted through September. The most recent data, and this is probably pretty close, I saw that said that 75,000 federal employees took the offer, but not all were accepted into the program. But this is a major number, because that could be 75,000 jobs gone.
Yeah, and I think it's, because I saw some people were like, and I got this from NPR actually, which people say it's unbiased. I think it definitely leans left. But regardless of that statement, NPR had said 75,000 initially came in, and then they kind of were reneged on that offer, and they were upset because the federal government didn't accept all 75,000. So, I mean, even let's say it's 40,000. So government was a decline of 16,000. Let's say it continues on that trajectory. I mean, you can see next month or the following month, all of a sudden government declines by 50,000 jobs potentially. I'll be very curious to see what that looks like. And that could push payrolls negative if government is that weak.
Yeah, next month in October, it's going to be a scary report.
Yeah, potentially. I mean, we'll see. I mean, hopefully there is some maybe pickup in the private sector, but we'll kind of discuss that further. I will say that the leisure and hospitality was a surprise to me, considering there was kind of weakness everywhere else. But that group actually produced a gain of 28,000 jobs in the month. And while much of this sounds concerning, I got to say the unemployment rate held relatively steady at 4.3%. And that doesn't incorporate the fact, I love to always look at this number, that 1.9 million or 25.7% of all unemployed people were jobless for 27 weeks or more. My belief is that many of those that have been unemployed that long, I mean, 27 weeks, you're now talking, 2.5 years-ish that you'd be unemployed? Oh, I'm sorry, not 27 weeks.
About 6 months.
About 6 months.
Yeah.
Not 27 months.
Right.
But again, 6 months, let's say. If you've been unemployed for 6 months, I can't imagine you've been looking for a job that hard.
And there's some people just don't really want a job. Like, if one great one came along, I would take it. But if you're not working for 27 weeks in this market, this job market, you really didn't want to work.
Well, maybe not this most recent one, but 5 months ago, it was pretty easy to find a job.
Yeah, yeah. I mean, well, again, well, we're going to talk about this in a minute about the labor turnover survey, but I just want to comment too with the unemployment rate low and deportations potentially weighing on the supply of workers. We just don't see how it would be possible to maintain a strong job market given the limited supply of workers. They're just not there. I know we're going to talk about the JOLTS report coming up next, but it's just the supply of workers is not there.
Yeah, I mean, the supply is not there. And I kind of want to go back to this point real quick about 25% of all unemployed, that long term. I mean, again, having a 4% unemployment rate, just very simply, you take 25% of the 4%. I mean, that's essentially 1%. So you're almost looking at
I'm going to repeat that again. 25 to 24 of the one.
25%, let's say, of the 4%, essentially.
Yeah.
I mean, that could push the unemployment rate if you kind of pulled out some of those people that are long term underemployed. I mean, you might be looking at an unemployment rate closer to 3%.
Yeah.
So I think that just shows how strong the labor market has been. But I mean, kind of jumping into your point now about job openings, we saw the job openings and labor turnover survey, and this was, again, another potentially negative headline depending how you view it, but it fell to 7.18 million, and this looks back 2 months, so this was in the month of July. That came in below the estimate of 7.4 million and marked the lowest reading since September 2024. It was only the second time since the end of 2020 that job openings came in below that 7.2 million, not dollar, 7.2 million number.
Yeah, and again, 2024. If I look back to September 2024, things were kind of doing okay. So I mean, we're just pointing out the direction things could be going. We're not saying hit the panic button because that's not happening. And if you look at job openings before 2020, well, nearly 7.2 million openings would have been a great number. In 2016, job openings averaged 5.86 million jobs. 2017 averaged 6.12 million jobs. 2018, job openings averaged 7.11 million. And then 2019, job openings averaged 7.15. So we always say a number means nothing at all unless it's something to compare it to. The job openings of 7.18 million that came out for July is not bad, but it is a slowdown of what we had before. And there's jobs out there. Maybe as we talking, we can't find somebody to fill those jobs.
Yeah, and I mean, again, I want to reiterate the 7.18 million, that would have been above average in every single one of the years we just discussed. So 2016 to 2019, the average was below 7.18 million in every single one of those years. So that would have been an above average job openings report when you look at it that way. I think it really just shows how crazy the job market got post-COVID.
Yeah, yeah. And I've talked, I think there are people out there that they don't want to take anything less but the perfect job, perfect environment, 3 days working from home. I mean, there's things that they want. And that, by the way, that working at home, I keep reading more and more that is getting slowly dissipating to where it's not going to be around at all.
Yeah, and I just worry, I mean, this post-COVID situation, we just got so accustomed to things that aren't normal. I mean, you got accustomed to stocks surging 15% a year. You got accustomed to real estate surging at levels that are crazy. You got accustomed to payrolls growing at 200,000 a month. You got accustomed to an unemployment rate that's around 4%. You got accustomed to job openings that were around 9-10 million. I mean, that is not how the economy is going to function long term, and we've gotten addicted to mortgage rates at 3%. That's just not going to happen. And I think we become so unrealistic with a lot of things. I mean, it just kind of hits the point that, you know, a lot of this bringing it back to reality, I'm going to call it, with job openings and, you know, the payroll data, I'm just not overly concerned about it. I mean, job openings, I think you could see fall back to like a 6 million range. Yeah. And I think we'd still be in an okay spot from a labor market perspective. But even with that lack of concern that I think we have in the job market and the economy as a whole, I just think we're going to see a Fed rate cut this month. I mean, the market now essentially has a 25 basis point cut priced in at 100%. Yeah. And now they also have a 50 basis point cut on the table, with markets putting it at about a 12% chance. So again, still super low. I don't think that's going to happen, but that is up from 0% on Thursday before the jobs report came out.
Yeah, and I do want to remind people there's one more inflation report coming out. I think it comes out on Wednesday, the CPI. I think it's Wednesday it comes out. That, I don't expect it to be high, but if that comes in high, that could change the whole ballgame. Because remember the CPE?
The PCE?
PCE, that came in kind of not favorable It was a little bit high. Not anywhere near the 2% they want to get to. That's what I'm talking about. It was like 2.8, 2.9, I think it was.
It came in right along expectations. The PCE, I don't hate PCE because obviously that's what the Fed looks at.
Right.
But PCE is almost guaranteed, as close to guaranteed as you're going to get in a lot of these data points to what the estimates are, because you're already going to have all of CPI and PPI, which flows through to PCE. So a lot of times PCE doesn't surprise because you already have that. CPI could, though, because we don't have that data point yet.
And I don't think it's going to be bad because I don't see much inflation. But if it comes in bad, that's going to put Powell on the fence because he's supposed to be this one that is really against inflation, which is a good thing. You don't want inflation. Could he change his mind saying, gee, CPI came in at 3.1%. I can't reduce rates. That's too far off my mark of 2% that he wants from inflation.
You can distort numbers however you want. So I am of the viewpoint that they will be cutting rates in September in a couple of weeks. I don't necessarily think it's the right thing to do, but I just don't see how they will not, given how weak this jobs report was.
Yeah, and I do think that a lot of pressure to reduce rates, but I don't. And why would Powell? It's like you're leaving in February anyways. It's like, no, I'm going to do the right thing. So, but
well, he's only one guy. He's still got to rally the other votes, and we know now that Bowman, Waller, they're going to vote one way. There's the new Fed governor. I don't think he'll be voting obviously at that meeting because I don't think he's been confirmed yet. But the other one left, so I don't know if Powell would have the votes.
Well, let's talk about that because we did hear from Fed Governor Christopher Waller, who was supposedly on the short list to replace Powell as Fed chair. He believes that should be a multiple cuts over the next few months, saying interest rates today are perhaps 1 to 1.5% points above the neutral level. Now, I want to talk about this because he's on the short list. Do you think if he said, no, I don't think rates should be cut, he'd be off that list so quick?
Oh, yeah.
I mean, are people kind of bowing down to Trump to get elected? I mean, is it the right thing? And it depends because we don't want runaway inflation, and that's the problem.
Yeah, I mean, it is a concern, and I think long term, I think rates are too high, but that doesn't mean long term is a year from now. I think rates could stay elevated, but 5-10 years from now, I don't think rates necessarily need to be this high.
Right.
I think it's like, I don't understand the point of maybe pressuring lower just to appease the market. And I do worry if we do go forward with 1 to 1.5% in terms of the cuts that we would see. I think you're just going to fuel this bubble higher, and it's just going to kind of kick the can down the road. And maybe 2027, you just have a huge blow up. I don't know.
And for years, I'd like the economist from J.P. Morgan Chase, David Kelly, and he kind of said that, this does help the market, but it's not really the right thing to do for the economy. And he's kind of worried about it. So he's always been a very calm speaker. I've listened to him, I think probably 20 years. And he always has common sense approach. And I think if there's not a big CPI, we could see a half-point cut, which I'm not sure it's the right thing or not. But we'll see.
I'd be very surprised at half a point. I'd be shocked at no cut. And I mean, obviously the most likely outcome is we're going to see a 25 basis point cut. I think it's on the 15th, so we'll probably still talk about this next week.
We'll see what the CPI did, but we'll talk more next week on